personal finance. That's a term that covers managing your money as well as saving and investing. Right? It encompasses budgeting, banking, insurance, mortgage, investments, retirement, on and on and on. The term often refers to, the entire industry that provides financial services to individuals and households and advises them about financial and investment opportunities. Now, individual goals and desires, right? And a plan to fulfill those needs within your financial constraints also impact how you approach everything. Right? To make the most of your income and savings, you need to become financially savvy. It's going to help you distinguish between good and bad advice and make intelligent financial decisions. Personal finance is about meeting your personal financial goals. Now, these goals could be anything, right? Having enough for short term financial needs, planning, retirement. Maybe you have a kid and you want to save for their college. Depends on your income, spending, saving, investing, personal protection, which is insurance and estate planning. Now, understanding how to manage finances or to be financially disciplined, it's led Americans to accumulate quite a ridiculous amount of debt. Americans are just taking on more and more and more debt to get stuff that they don't really need, stuff that they want, making managing personal finances more critical than ever, especially when inflation is eating away at that purchasing power. Prices going up, your money buys less. It's just, what are you doing? Let's go over some personal financial strategies because the sooner you start financial planning, the better, right? It is. It is what it is. But it's never too late to create financial goals to give yourself and your family financial security and freedom. So let's go over some, we'll call them best practices and tips for personal finance. First thing we want to talk about, the money you make, that income. What else, right? Because it's all for nothing if you don't know how much you bring home after taxes and withholding. So before deciding about, anything, you need to know how much you're even making. What is your take home pay that you receive? Right? Now that we know how much we make, time to make that budget. Now, a budget is essential to living within your means and saving enough to meet your long term goals. So, we'll use an example of 50-30-20 budgeting, right? Now, this method is going to offer a great framework. Let's break it down. 50% of your take home pay or your net pay after taxes goes towards living essentials such as rent, utilities, groceries, transport. Then 30% is allocated to discretionary expenses such as dining out, shopping for clothes, giving to charity can go in this category as well. And then 20% goes towards the future, paying down debt, saving for retirement and emergencies. Now, that's a general rule. If you want to, you could switch those two and do 30% for paying down debt instead and 20% for discretionary. Now, it's never been easier to manage money. There's a bunch of, apps out there that make day-to-day finances in the palm of your hand just easy, right? One example is you need a budget, right? It's going to help you track and adjust your spending to control every dollar you spend, right? Then there's Mint. It streamlines cash flow, budgets, credit cards, bills, and it can even track your investments all in one app. It automatically updates and categorizes your financial data as information comes in, so you always know where you stand financially. Now, the next thing we're going to talk about, I'm sure you hear this all the time. Sometimes maybe like, well, I can't do that, but you need to pay yourself first. It's important to pay yourself first, to ensure money is set aside for unexpected expenses, medical bills, car repair, day to day expenses if you get laid off. The ideal safety net is somewhere around 3 to 12 months of living expenses. Now, financial experts generally recommend putting away about 20% of each paycheck every month. Once you filled up your emergency fund, don't stop. Continue funneling the monthly 20% towards other financial goals, retirement fund, paying down debt, stuff like that. Which is the next topic we need to talk about. Your debt. Now look, it sounds simple enough. Don't spend more than you earn to keep debt from getting out of hand. But, of course, most people have to borrow from time to time. Now, Sometimes going into debt can be advantageous, right? If it leads to acquiring an asset. Now, taking out a mortgage to buy a house, that might be one example. Still, leasing sometimes can be more economical than buying outright. Whether renting a property, leasing a car, or even getting a subscription to computer software. On the other hand, minimizing repayments, right, to like say interest only, right, can free up income to invest elsewhere or put into retirement savings while you're young when your nest egg gets the maximum benefit from compounding interest. Some private and federal loans are even eligible for a rate reduction if the borrower enrolls in autopay, right? I mean, one of the crazy debts we have going on now is the student loans, right? Student loans account for 1.6 trillion of consumer debt. I mean, if you have outstanding student loan debt, you should prioritize it, right? There's just a bunch of loan repayment plans and payment reduction strategies available. So if you're stuck with any high interest rate, debt, paying off the principal faster makes sense. Now, the next thing we need to talk about, it's similar, right? It's borrowing only what you can repay. Because credit cards are major debt traps. But it's unrealistic to not own any, right? Like, you don't have a credit card, you don't have any credit. Furthermore, they have applications beyond buying things, right? They're crucial to establishing your credit rating and a great way to track spending, which can be a considerable budgeting aid. Now, credit needs to be managed correctly, meaning you should pay off your entire balance every month or keep your credit utilization ratio to a minimum. Now, when we say minimum, really what we're talking about here is don't use more than 30% of your total available credit. Easy, right? So if you, simple terms, if you have $1,000 card, you want to be under 300. So, given the extraordinary reward and incentives offered these days, like think cash back, it makes sense to charge as many purchases as possible if you can pay your bills in full. Now, using a debit card, which takes money directly from your bank account, is another way to ensure that you're not going to be paying for accumulated small purchases over an extended period with interest. Now, when you have your credit, you need to make sure you're keeping track of that credit score because credit cards are the primary vehicle through which your credit score is built and maintained. So watching your credit score, right, goes hand in hand, right? So if you ever want to obtain a lease, a mortgage, or any other type of financing, you're going to need a good solid credit report. Now, there's a variety of credit scores available. The most popular one is the FICO score. Now, factors that determine your FICO score include like your payment history, the amounts owed, length of credit history, your credit mix, your new credit. And then your FICO scores are, calculated from a range of 300 to 850, right? So 300 to 629, bad. 630 to 689, fair. 690 to 719, it's pretty good. 720 to 850, that's what everyone wants. So, when you're paying your bills, maybe set up direct debiting where possible. That's the way you never miss a payment. And subscribe to reporting agencies that provide regular credit score updates. In addition, you can detect and address mistakes or fraudulent activity by monitoring your credit report. There are federal laws that allows you to obtain free credit reports once a year from the big three major credit bureaus: Equifax, Experian, and TransUnion. Now, reports can be obtained directly from each agency, or you can go sign up at annualcreditreport.com and get it, right? Now, some credit card providers like Capital One, they're going to provide customers with complimentary regular credit score updates, but it may not be your FICO score, right? So, the other thing we need to worry about, man, you need a plan for your future. You can't just hope everything works out. You need a plan in place. You got to protect the assets in your estate and ensure that your wishes are followed when you're gone. Right? Be sure you make a will, and depending on your needs, possibly set up a trust or two or five or 10. It should also, you should look into insurance and find ways to reduce your premiums, right? Auto, home, life, disability, right? Long term care. Periodically review your policy to ensure it meets your family's needs through major milestones. Other critical documents, including a living will and a healthcare power of attorney, while not all of these documents directly affect you, all of them can save your next of kin considerable time and expense when you fall ill or become incapacitated. And retirement might seem like forever away, but it's going to be here a lot sooner than you think. Experts suggest that most people will need about 80% of their current salary in retirement. The younger you start, the more you benefit from what the advisors call the magic of compound interest. How something itty bitty bitty grows really, really big over time. Now, setting aside money for your retirement not only allows you to grow over the long term, but it can reduce your current income taxes if funds are placed in a tax advantage plan. Think, an IRA, an individual retirement account, a 401k, or a 403b. Right? If your employer offers a 401k or 403b plan, start paying into it immediately. Especially if your employer has matching contributions. By not doing so, you're just giving away free money. Take time to learn the difference between a Roth 401k, a traditional 401k. Right? Investing is only one part of planning for retirement. Just one. All right. Other strategies include waiting as long as possible before opting to receive Social Security, right? Converting a term life insurance policy to permanent, stuff like that, right? I mean, you need to get insurance, right? Especially because as you age, it's natural for you to accumulate many of the same things your parents did: a family, a home, the stuff you own, health issues, right? All of it. Insurance can be expensive if you wait too long to get it. Healthcare, long term insurance, life insurance. It all increases in cost the older you get. Additionally, you never know what life will send your way. If you're the sole breadwinner of the family, or you and your partner both work to make ends meet, a lot depends on your ability to work. With insurance, it can cover most of the hospital bills as you age, leaving your hard earned savings in your family's hands. Medical expenses, that's just one of the leading reasons for all this debt people have. Now, if something happens to you, life insurance can give you, you know, it can give you those that you leave behind, like a buffer zone, just to deal with it, right? And one less thing when you go that they have to deal with, right? And get them back on their feet. So, just really look into buying insurance. And there's so many different kinds, so make sure you do your homework. Personal finance, it's managing your money to cover expenses, save for the future. I mean, it covers so much stuff, right? Managing expenses, debt, saving, investing, planning for retirement, planning for when you pass away, right? Insurance, build wealth, ensure wealth is passed on to the people you want it to. Understanding how to manage your finances is important, right? It can help set you up for a life without debt. You gain control of financial stresses and have a way to manage the expensive surprises that can just be thrown at you, right? So hopefully we're going to get your mind on the right track, get you thinking about the things that you need to do, and get to it. Right? I hope you guys enjoyed this video. Till I see you guys in the next one. Y'all be safe.